Assalamualaikum warahmatullahi wabarakatuh and greetings. Let us begin our FAR570 class for the topic income tax. I start with a quick revision of what you have done in the previous FAR subject, maybe in FAR510. Okay, previously in your FAR510 paper, you are given a trial balance. This is a sample of FAR510 past year's question. In the trial balance, in order for you to prepare the financial statement, you are given information about tax paid. You have also information on tax recoverable. Sometimes you have information on tax payable. You are also given information related to deferred tax, and in the additional information you have information on tax expenses of the company for the year. So in preparing statement of profit or loss and other comprehensive income, what you normally do is you're going to take into consideration all the information given and find the tax expenses for the year to be deducted from your profit before tax. So tax payable each year is based on tax rules, whereas tax expenses, the one that you show in your statement of profit or loss and other comprehensive incomes, are according to accounting standards. The amount charged as tax expenses derived from following accounting standard will differ from the amount of tax that is to be paid for the year, which is derived from tax rules. This is because the rules for calculating tax payable and the accounting principle applicable for computing the tax expenses are different. The tax expenses would include the tax payable and any tax that is deferred, which can be known as tax postponed for payment to a later date. Do you still remember how do you prepare your financial statement? How do you find your deferred tax to be shown in your statement of financial position? Previously, you may have learned that during diploma level, or you should have learned that in your FAR510. Do you still remember that? So let's refresh some of your previous knowledge. Tax that is incurred for the current period but the payment are deferred to the future period is referred to as deferred tax. Tax payable is calculated on chargeable income that is profit according to the tax rules and is payable in the current year on a pay-as-you-earn basis. Chargeable income may not be the same as accounting profit. Accounting profit, the one that you normally calculate, is calculated in accordance with generally accepted accounting principle, whereas chargeable income is computed according to the tax rules. There are differences between tax rules and generally accepted accounting principle with regard to the computation of profit. These differences are either permanent or temporary different. Permanent different are ignored for deferred tax accounting. Example of permanent different are donation to unapproved charity, penalties and fines. Payment made by the company but not allowed under tax rules. The company may have lower accounting profit than chargeable. So first point that you need to be clear is accounting profit that you normally calculate is not the same as taxable profit or chargeable income. Tax on profit is paid in the year profit are earned. Tax losses can be carried forward and offset against the future profit indefinitely but not against prior period profit. Tax payable is computed on chargeable income, i.e. profit according to tax rule, and is payable in the current year on a pay-as-you-earn basis. So we have some adjustment to make from our accounting profit in order for us to find chargeable income or taxable profit. So tax expenses that you normally calculate comprise of tax payable and changes either increase or decrease in deferred tax liability. It is the amount included in the determination of profit for the current period in respect of current tax and deferred tax. Tax expenses is based on accounting profit, which is computed based on generally acceptable accounting principle. The rules for computing tax payable and the accounting principle applicable for computing the tax expenses are different. So tax expenses that you show in your statement of comprehensive income is either tax payable plus increase in deferred tax or tax payable minus decrease in deferred tax. Okay, provided in this example, we have A.A. Berhad has calculated its tax payable as 65,000 for the year 2019. The opening balance in its deferred tax liability was 45,000 and the year-end balance was determined to be 55,000. So calculate the amount of tax expenses. So we can see that tax payable for the current year is 65,000. During the year also, we have increase in deferred tax from 45,000 increase to 55,000. So we have increase of 10,000. So that year tax expenses is equivalent to 75,000. So the difference between the opening and closing balance of deferred tax liability will affect the amount of tax expenses. For 2019, there is an increase of 10,000 in the deferred tax liability, which will be part of tax expense. Okay, let's look at the difference between tax payable and also tax expenses. Okay, a company acquire a plant costing 400,000, which is depreciated at 10% per annum on cost. The tax depreciation or capital allowance is 40% in the first year and 20% in the subsequent year. The profit before tax for each year is 800,000. Income tax rate is 20%. Tax payable and tax expenses will be as follow. So the one that we have in the red is calculation based on accounting principle. Meanwhile, the one that we have in blue is calculation of taxable profit based on tax rules. Okay, so if we look at profit before tax, according to accounting principle, we have 800,000. Okay, in calculating 800,000, earlier we already minus depreciation of 10%, which is form part of the expenses. So our tax expenses will be 20% from 800,000. The total of tax expenses is 160,000. However, according to tax rule, tax depreciation or capital allowance is already stated at 40% in the first year and 20% in the subsequent year. So according to tax rule, they already give a standard percentage to substitute the depreciation amount. So the adjustment that you need to do is, because previously in finding the profit before tax, we already minus depreciation of 40%. So for the adjustment, sebab dah tolak, so you kena tambah balik 40,000. Okay, to adjust for the depreciation, and then to follow the tax rule, then you minus with the capital allowance. So it's like masuk balik depreciation and then substitute the adjustment with capital allowance, which is according to tax rules. So based on that, you have the new amount of taxable profit, which is 680,000. Calculation of tax payable, which is 20%, based on taxable profit 680,000, giving you a tax payable of 136,000. So if you follow accounting profit, you will get tax expenses of 160,000, but when you calculate using tax rules, you will have tax payable of 136,000. So we're going to apply the same throughout the 5 years period, where you can see that for depreciation, the amount will be fixed at 10% per annum. However, capital allowance will be reduced. First year 40% and subsequent year is 20%. So you can see in the capital allowance deducted. So we have 40% first year, 20% for 3 years, giving us a total of 100% already. So by year 5, there is no more capital allowance provided. So you can see that there is a difference between tax expenses according to accounting rules and also tax payable according to tax rules. So the difference between tax payable and tax expenses is shown below. So you can see that the difference arises for year 1, 24,000. For year 2, the difference between tax expenses and tax payable is 8,000. So the difference will of 24,000 in the first year and 8,000 in the next 3 years will become payable for year 5 onward. So in the first year, the entity will charge 160 as tax expenses, but will pay only 136,000. So it has a deferred tax of 24,000. Okay, sebab you charge 160 to your statement of comprehensive income, but the one that you actually pay is 130,000. So the difference, you deferred to the future year. You deferred to the second year. And then in the second year, tax expenses, you charge to your SOCI also 160, but you only pay 152 for year 2. So you have a difference of 8,000. 8,000 also deferred to the next year. So you have two amount, 24,000 deferred from year 1. Then you have 8,000 deferred from year 2. So at the end of year 2, the amount deferred will be 32,000. Deferred mean you tak bayar lagi this year, you going to bayar in the future year. Okay, the same thing happen for year 3 and also year 4. But if you look at the effect in year 5, tax expenses it maintained at 160,000. However, for tax payable is already increased since you no longer have the capital allowance amount. So this time the difference will be negative. So this negative amount will be covered by deferred tax that you already have. Okay, so your deferred tax balance at the end of year 4 is 48,000, but at the end of year 5 it will be 40,000. Okay, so faham tak apa maksud deferred? Deferred maksudnya you tak bayar lagi in the current year, you deferred to the future year. So at the end, when there is a time where your tax payable will be more than your tax expenses, so masa tu you akan guna you punya deferred tax. Okay, welcome back for the next section. Actually, I record this slide on a different day. So on this slide is given the definition which related to this topic. I will leave it for you to read on your own, as well as you can refer to this in answering your tutorial question. Okay, briefly, when we talk about temporary different, okay, temporary different can either be taxable temporary different or deductible temporary different. Okay, taxable temporary different are difference that will result in taxable amount in determining taxable profit or loss of future period when the carrying amount of the asset or liability is recovered or settled. Okay, whereas deductible temporary different are temporary different that will result in amount that are deductible in determining taxable profit of future period when the carry amount of the asset or liability is reserved. So you need to understand two things. One, temporary difference maksudnya perbezaan disebabkan masa. Okay, timing of calculating accounting profit as well as taxable profit. And then in this temporary different, kita ada dua pula. Taxable yang akan dikenakan tax tapi belum kena lagi tahun ni. Mungkin akan kena tahun depan because of the different rules. And then we have deductible temporary difference, which mean that tak kena lagi tahun ni, tapi akan dikira tahun depan, tapi dia dibenarkan untuk tolak. Jadi adjustment dia akan jadi tahun depan, tapi tiada tax yang dikenakan because it's deductible temporary different. Okay, a much more detailed explanation on the temporary different. Okay, you need to be well versed on temporary different, and also because there are lots of past year's question that ask you about temporary different. Okay, so you can read from this also. Temporary difference where company pay tax on its chargeable income computed according to tax rule. Again, you need to be able to differentiate what is the difference between accounting rules and also tax rule. From accounting rules, you have your normally accounting profit yang you kira dalam SOPL. And then under tax rule, what you will get your taxable profit. Okay. So accounting profit is computed in compliance with the requirement of relevant Mfrs. So tax payable is not equal to your tax expenses. The difference is basically due to timing. Okay, over a given time period, the total tax payable and tax expenses may equal, which means that that's why we call it temporary different. Okay, because of the timing. Dalam tax rule, pengiraan tu tak diterima. Tapi dalam accounting profit, kita kira guna standard which allow for us to deduct that amount. Okay. Kalau you tengok example, you may be able to understand it further. Example adalah expenses accrued. Okay, let's take for example interest expenses accrued. Okay, so if you understand the concept of accrued, which means that you going to record the expenses when it is incurred but not yet paid. Okay, for example, interest expenses accrued, which mean that katakanlah your interest until end of the year 31st December total katakanlah 100 sebulan. So kalau setahun 1,200, tapi you cuma bayar pada Januari tahun depan. Jadi according to tax rule, we already incurred, kita dah masukkan this expenses amount 1,200 to the calculation of our expenses, right? So 1,200 walaupun belum bayar, kita dah masukkan dalam kita punya pengiraan accounting profit. Jadi kita punya profit dah pemberkurangan sebanyak 1,200. Okay. Whereas according to tax rule, expenses are only allowed to be taken into consideration when it is paid. So according to tax rule, 1,200 tu cuma diambil kira tahun depan. Faham tak? That's why we call it temporary difference. Okay. Next example, if we have expenses, we have also a situation where we have income received. Income received in accounting rules, if we have income, we record it when it is earned, not as money received. Yang ni in the case of prepayment lah. Contohnya, kita terima sewa untuk tahun depan pada tahun ini. Katakanlah total sewa setahun 1,000. Tapi kita bayar sewa kan kita bayar awal. Jadi contoh orang tu nak sewa untuk tahun depan, dia dah bayar tahun ni. Jadi according to accounting rules, kita tak masuk. We don't include the rental income in the current year tahun ni sebab kita pakai konsep accrual and prepayment. Okay, so bila kita tak masuk tahun ni, jadi kita punya pendapatan tu tak dikira lah untuk tahun ni sebab pendapatan tersebut according to accounting ia adalah pendapatan tahun hadapan. However, if you follow tax rule, income will be taxed on money received. So according to tax rule, tahun ni kita dah ada pun income tu. Sebab kita terima duit sewa tahun depan pada tahun ini. So that will be a timing difference between pengiraan guna accounting rule and also tax rule. This timing difference give the temporary difference in the calculation of tax payable. Okay, another example which relates to your accounting rules, it refers to your research and development costs. Okay, as you previously learned, okay, kalau research and development cost, you need to identify it separately, where according to the Mfrs, research cost will be written off as expenses, whereas development cost, kalau cukup syarat-syarat capitalized, it will be capitalized to asset. Maknanya tak masuk dalam you punya profit or loss. However, for tax rule, both research and development costs are allowed as deductible expenses in the year incurred. So, nampak tak perbezaan dia? Okay, kalau contoh development cost, kalau kita capitalize our development cost, kita tak masuk dalam SOPL, kita debit as asset. However, kalau according to tax rule, development cost yang kita bayar tu patutnya ditolak sebagai expenses in the year is incurred. So, ini adalah contoh-contoh that relates to the timing difference. Another example is different quantum of expenses, which means that cara pengiraan applied by accounting rules and tax rules is different. Okay, for example, depreciation. In accounting, you charge depreciation as expenses based on either straight line method, percentage of depreciation, you have estimated useful life and other factors. So we can see that according to accounting rules, depreciation charge will be different from company to company depending on their estimation. However, according to tax rule, they have a uniform or standard uh, calculation for depreciation, which are different from the company depreciation rate. So you need to adjust for this depreciation and also capital allowance according to tax rules. If we understand the concept of permanent different, temporary different, then it would be easier for us to understand what is permanent different. Permanent different is items that are not allowable for tax purpose but will be incurred by the entities. For example, donation to an approved charity, entertainment expenses, penalties and fine, dismantling and decommissioning costs, meaning that the entity deduct this to arrive at the accounting profit, but the tax rule will disallow its deduction. Therefore, permanent difference are ignored in the computation of deferred tax. Okay, let's take a short break before we continue further. Continue further with deferred tax accounting. According to Mfrs 112, it's required an entity to recognize and account for any deferred tax liability or asset. Okay, any deferred tax liability or asset. Deferred tax liability will arise if the recovery of the carrying amount of the underlying asset or settlement of liability give rise to a higher tax payment in the future. Okay, carrying amount refer to what you have in your statement of financial position. If the recovery or settlement may give rise to a lesser than tax payable, then it will give rise to deferred tax asset. Okay, you can refer back to this definition, okay, in order for you to recall or remember what is we going to use in the calculation. Okay, so this is a summary of what we mentioned to be higher of carry amount or lesser of carry amount in deferred tax account. In summary, the difference between accounting rules and tax rule, we have two types of difference: temporary difference and permanent difference. Permanent difference we totally ignore because it does not have effect. But for temporary difference, we have taxable temporary difference and also deductible temporary difference. So now let's practice. Let's do some practice. We look at example 1. An entity has a plant costing 200,000 on which 40,000 depreciation has been charged. Capital allowance, that is tax depreciation, claim is 50%. Okay, calculate the carry amount and tax base of the asset. So you show your working by using this columnar table. Okay, you need to compare carry amount using accounting rules bandingkan dengan tax base using tax rule. Okay, kalau kita tengok carry amount using accounting rules, it's actually sama macam you prepare your statement of financial position. Okay, where you have cost of land 200,000 minus depreciation for the year. Okay, katakanlah this for first year. So carry amount in the statement of financial position is 160,000. But according to tax base, cost of plant sama 200,000, but tax base you need to minus capital allowance. So capital allowance given is 50%. So your tax base asset value is 100,000. So this is the thing that you need to find first. Okay, carry amount according to statement of financial position and your tax base asset value, and then you compare. So since this is asset, you compare carry amount 160 compare with 100,000, you have a difference of 60,000, and this difference. Okay, for example number 2, we look into liability. Okay, an entity took out a 10% 8 million loan on 1st April 2019. Interest on loan is paid every 12 months in arrears. Maknanya lepas 12 bulan baru dibayar. Find the carrying amount of any liability and tax base. So carry amount dan tax base juga, tapi this time adalah untuk liability. And then determine the taxable temporary difference or deductible temporary difference for the accounting year ended 31st December 2019. Okay, so this is liability. You use the same table, columnar table juga. Ada carry amount column, ada tax base column. So kalau kita tengok loan is liability, the amount in your statement of financial position 8 million. For tax base is also 8 million. But for interest, in the statement of financial position, since we take into consideration accrued interest, so kita tunjuklah walaupun belum bayar, it considered as interest accrued 10% times 8 million times 9/12, sebabnya dia mula daripada April till December. So dalam statement of financial position memang kita akan tunjuk interest accrued 600. But according to tax base, okay, according to tax rule, dia cuma akan charge taxation when the interest is actually paid. So untuk tahun ni interest belum dibayar lagi because interest will be chargeable 12 month in arrears. So dia tak ada pengiraan untuk interest expenses. So nil, kosong. So kita bandingkan carrying amount of interest accrued 600 dengan kosong. So we have a difference of 600,000. So this difference is known as deductible temporary difference on the accrued interest. Let's do some exercise. You refer to the exercise provided in the Google Classroom. Okay, let's do some exercise. Tengok dah ada macam-macam gaya dah. Duduk dengan slide terguling ada, terbaring ada. Pergi entah mana-mana pun tak tahu dah. Okay, kita buat exercise and we continue discussion in the Google Classroom ataupun dalam WhatsApp group saja.